Good afternoon and welcome to the Deep Dive. I'm really glad you could join us today as we dig into the market action from Friday, October 3rd, 2025. It was, well, honestly, one of the strangest days I can recall in terms of market signals. Just a massive contradiction.
Oh, absolutely bizarre. You have this backdrop of, pure political chaos. The U.S. government shutdown was dragging into its third day. Lots of friction, real economic impact starting to bite.
Right? Furloughs, services suspended.
Exactly. And then you look at the market screens. Equities just soaring,
Hmm.
hitting all-time record highs. It felt completely detached from that reality.
Totally detached. And that's really our mission for this deep dive, to unpack this, what we're calling the Great Disconnect. How on earth do markets hit these incredible peaks while Washington is gridlocked? We need to figure out what specific financial levers were being pulled, what were the big forces driving investors. We think there are two dominant ones, and we also need to uncover the hidden risks, because they are definitely there.
And the records weren't trivial, were they? This wasn't just a small bump. It capped off a really strong week. The S&P 500, it closed at a new record, 6,715.35. That was up 0.1% on the day. The Dow, the DJI, also hit an all-time closing high, 46,519.72, up 0.2%.
And tech leading the charge again.
Yeah, the Nasdaq Composite was the strongest, really showing where the focus is. It gained 0.4% to finish at 22,844.05.
So that's 5 straight winning sessions for all the major indexes, a pretty undeniable streak of strength. Okay, let's unpack this. 5 winning days, record highs, right in the middle of a government shutdown. That's getting quite serious. I mean, if you're just watching the news, this seems completely impossible. How is the market making sense of this?
Well, it really shows, I think, a fundamental shift in how the market is weighing different kinds of risk right now. It's not that investors are, blind to the shutdown. They see it, but they seem to have decided that these other forces, these huge global tech trends and expected moves from the Fed are just much, much bigger deals in the long run.
So they're looking past the immediate mess in D.C.
They're prioritizing, yeah, global tech cycles, future central bank policy. Those seem to trump the domestic political squabbles, at least for now.
Okay, let's dig into that political side first, because you really can't understand October 3rd without grasping just how messy the shutdown situation was. Third day, hundreds of thousands of federal workers furloughed, services grinding to a halt, agencies struggling. Now, we often hear, oh, markets just ignore shutdowns. Why is that the typical view, and maybe why is this time a bit different?
Right. The historical playbook is pretty clear. Markets usually treat these shutdowns as, well, short-term noise, political theater almost. The thinking is, they almost always get resolved relatively quickly, maybe a week, maybe two. And the economic hit, it often gets smoothed out later when those furloughed workers get back pay. So the net effect looks more like a temporary delay, not a permanent loss to GDP.
So investors typically just shrug, look past it, focus on earnings next quarter.
That's the standard procedure, yeah. But the tension this time, as you said, is this really widening disconnect. We've got these sky-high stock valuations crashing right into what feels like much deeper economic and political uncertainty than just a typical budget fight.
What makes it feel deeper? Is there a specific risk factor?
There is, and it's quite significant. What makes this particular shutdown potentially more dangerous is the rhetoric. Specifically, we had reports surface that President Trump was actually discussing the possibility of large-scale permanent layoffs of federal workers.
Permanent layoffs, not just furloughs.
Exactly. Using it as a pressure tactic against the opposition.
Wow. Okay, that definitely moves beyond short-term political noise. That's concrete economic damage.
It absolutely is. A furlough is temporary,
Yeah.
right? People expect to get paid back.
Yeah.
A mass layoff is permanent income destruction. Gone. If that were to actually happen, even partially, you're talking about hitting hundreds of thousands of households directly.
And consumer spending is what, like 70% of the U.S. economy?
Roughly, yeah. So if you start hitting household incomes hard,
Yeah.
especially concentrated in areas around government centers, that's a direct, undeniable drag. It hits confidence. It is future spending plans. That's a real economic consequence the market couldn't just easily brush off.
Okay, so if that very serious risk is out there, potentially mass layoffs,
Yeah.
why were big investors still buying the S&P 500 hand over fist? What are these underlying themes powerful enough to make them discount that possibility?
It seems they're operating on this deep conviction, a conviction that the long-term structural tailwinds from technology, plus the shorter-term boost from expected easier money from the Fed, that these forces are just fundamentally stronger, more influential than the gridlock in Washington.
So they're basically saying the global drivers are bigger than the domestic problems.
Essentially, yes. They're saying the things driving corporate profits, global chip demand, building out AI infrastructure, the expectation of lower interest rates, these things will power through, even if DC messes things up badly. It's a calculated bet, a gamble that the global business cycle can carry earnings forward despite the political risk at home.
That really frames it well. It's not blind optimism. It's a conscious decision to prioritize these global and tech narratives over the immediate political instability.
All right, let's pinpoint those narratives. You mentioned two dominant forces anchoring this resilience. These are the pillars holding up these record highs. Let's dive into them. What's the biggest structural driver here?
Oh, without a doubt, the number one engine, the real fuel for this bull market right now is the AI investment cycle. The enthusiasm for artificial intelligence isn't just high, it's relentless. It seems completely insulated from political noise.
And it's translating into actual money movement.
Yeah.
Massive amounts. Huge, continuous capital flows are targeting everything connected to AI. Companies designing the chips, companies building the giant data centers, the ones developing the software, the foundational models, all of it.
Okay, that's engine number one. What's the second one? The one that gives that immediate policy comfort blanket.
That would be the widespread, deeply ingrained expectation of monetary easing. Call it monetary easing expectations. The market is just stubbornly convinced the Federal Reserve is going to keep moving towards lower rates, towards accommodation.
And bad economic news actually helps that narrative.
Crucially, yes. Any weak data point we get, and we got a few significant ones this past week, it's immediately seen as proof. Proof the Fed needs to cut rates, and probably soon. This anticipated easing, it lowers the cost of borrowing, it makes future profits for growth companies look more valuable today.
Because the discount rate is lower.
Exactly. And that provides a really powerful immediate tailwind for stock prices.
Let's pause on that AI theme for a second. Because the scale of investment we're talking about here is, well, it's staggering. It almost feels like systemic risk territory itself. You mentioned news driving the fervor, like OpenAI's reported $500 billion Stargate AI infrastructure project. $500 billion.
$500 billion. Just let that sink in for one project.
What does that even mean in practical terms? What are the ripple effects of dedicating that kind of capital?
Well, $500 billion for infrastructure. It's arguably one of the largest single industrial investment plans in history. I mean, you're talking about levels comparable to the space race or maybe wartime mobilization efforts. It's huge.
And that money doesn't just sit there.
No way. It creates this massive demand pull across the economy. Think about the energy required. These AI data centers need unbelievable amounts of power. That puts huge pressure on utilities, on renewable energy development. It drives demand for specialized stuff, copper, advanced cooling systems. It forces the chip makers, the NVIDIAs of the world, to ramp up production even faster.
So Stargate kind of validates the whole AI investment thesis for the market.
It absolutely does. It convinces investors that the demand for this AI computing power is effectively limitless, at least for the foreseeable future.
But then you hear warnings, like from Goldman Sachs CEO David Solomon. He said something like, while the bull market doesn't worry him, a reckoning will be coming for AI technology's winners and losers. If the CEO of Goldman is warning about a reckoning, why are institutions still throwing hundreds of billions at these projects right now? Are they just ignoring him?
I don't think they're ignoring it. I think they're accepting the binary risk that comes with any massive technological disruption. Solomon's point is really about execution risk, isn't it? He's saying, yes, AI is transformative, it's the future, but
will every company riding this wave actually deliver the goods?
Exactly. Will they deliver the returns needed to justify these multi-hundred-billion-dollar valuations? What if Stargate underperforms? Or a competitor builds something better, faster? Or the energy costs just become too high to sustain?
Then those hundreds of billions could evaporate. Capital misallocation on a grand scale.
That's the risk. The market is making huge bets on who the winners will be. If they bet wrong on a few key players, the unwind could be absolutely brutal. That's the sort of structural fragility hiding underneath these AI-fueled record highs.
It's an incredible risk-reward setup. Generational wealth on one side, potentially catastrophic losses on the other. Okay, so shifting from those big structural risks to the immediate policy risks. The government shutdown created this major problem, the data vacuum. Can you explain what that actually means for the Fed and for investors on a practical level?
Yeah, the data vacuum basically means the pilots are flying without their main instruments. You know, the most critical economic reports, the ones everyone relies on, especially the official September non-farm payrolls report and the unemployment rate, they're just postponed indefinitely while the shutdown lasts.
And the Fed famously says its policy is data dependent.
Right, so how can they be data dependent when the key data isn't there? It's debilitating for them. They need those official numbers to really gauge how tight the labor market is, what the true pace of inflation looks like. Without them, making informed decisions about interest rates is incredibly compromised. They're kind of flying blind.
And the market. Investors don't just stop because the government data is late. What do they do instead?
They don't stop. They're forced to put much, much more weight on whatever data is coming out. And that usually means private sector data.
Like surveys or payroll processors?
Exactly. Things like the ISM surveys, the ADP employment report.
Mm.
But here's the key distortion. These private reports, while useful, they often don't have the same statistical rigor or the broad coverage as the official government numbers. They can be more volatile, less comprehensive.
So what did that available private data actually show this past week? Because the market reaction was, well, pretty weird, but also kind of predictable.
The private data that came out was unequivocally weak, no question about it. And that's why the market rallied. It fed right into that easing narrative.
Okay, what were the specific numbers?
Two key ones. First, the ISM services PMI. That tracks the huge services sector, right? Most of the U.S. economy. It fell sharply, much more than expected. Dropped from 52.0 down to 50.0.
50.0, that's literally the line between expansion and contraction.
Precisely. Anything below 50 means contraction. So 50.0 basically signals stagnation. Growth in that crucial services sector just stalled out completely. Orders, employment production, all slowed down markedly in the report.
Okay, that's one piece of weak data. What was the other?
The ADP report. That's the big private payrolls processor. It tracks private sector jobs. It unexpectedly showed a net loss of jobs in September. 32,000 jobs lost, according to ADP.
A net loss. Not just slower growth, but contraction.
Correct. So you put those together. The massive services sector grinding to a halt and private companies actually shedding jobs. That's the perfect recipe if you're hoping for the Fed to ease policy.
Right, so we get data showing job losses, economic stagnation, and the market hits record highs. This is that bizarre but really fundamental bad news is good news loop in full effect.
Exactly that. Weak data is seen as bullish because it confirms the market's bet on the Fed cutting rates. It basically tells investors, okay, the economy is finally cooling off enough. The Fed now has the justification, the political cover, to start cutting rates, maybe aggressively.
And the conviction level on that rate cut is high.
Astonishingly high right now. The CME FedWatch tool, which tracks market probabilities for Fed moves, it's pricing in a near 100% probability of a rate cut at the very next FOMC meeting.
Wow, near 100%. That's about as fully priced in as you can get.
Yeah.
But relying so heavily on this incomplete private data to justify such a strong bet brings us to this idea of risk asymmetry analysis. What does that term mean, and why is it so critical right now?
Risk asymmetry is basically the idea that the potential downside, the pain if you're wrong, isn't balanced by the potential upside, the reward if you're right. Right now, the market seems perfectly priced for the good outcome, which, in this upside-down world, is the Fed cutting rates because the economy is weak, all the potential gain from that expectation, it's pretty much already baked into prices.
So there's not much more upside if the weak data is confirmed.
Very little. The asymmetry comes in because what happens if the official data, when we finally get it, tells a different story? What if the official non-farm payrolls report shows the labor market is actually much stronger than ADP and ISM suggested? Let's say the economy added 200,000 jobs instead of losing 32,000.
Then that whole perfect Fed needs to cut narrative just evaporates instantly.
It shatters instantly. There's no more upside left from the dovish bet. Instead, you have massive downside risk because that near 100% probability of a rate cut has to unwind immediately.
So the market has pushed all its chips onto the weak data square. If the real data comes up strong, the correction would be way more severe than any remaining upside.
That's exactly it. It would likely trigger a rapid and painful repricing, as the analysts say. All those investors who piled into growth stocks, tech stocks, anything sensitive to interest rates based on those low discount rate assumptions, they'd face a huge unwind. The market isn't priced for economic strength right now. It's priced only for policy easing. That makes this whole equilibrium incredibly fragile. It's basically balancing on the hope that postponed government reports will confirm the gloomy private data.
And that fragility you're describing, it wasn't just theoretical. It showed up in the actual mechanics of the market on Friday, didn't it? If we look beyond the headlines to the market internals, the rally to new highs wasn't exactly a, buying frenzy. It looked much more cautious.
That's a really important point. It helps distinguish between a truly broad, confident bull market and something narrower, maybe more fragile. Take volume, for instance. Total trading volume for the day was about 18.77 billion shares. That was actually a tick below the recent 20-day average, which was around 18.83 billion. So record highs on slightly below average volume, not exactly roaring conviction.
And market breadth, the number of stocks going up versus down.
It was positive, yes. Advancing stocks did outnumber decliners. On the NYSE, the ratio was about 1.16 to 1. On the NASDAQ, a bit better at 1.37 to 1. But again, that's not overwhelming. It's a gentle lean to the upside, not a powerful, aggressive, broad-based buying signal, more like cautious participation.
And the sector performance really hammers home how narrow this market feels. Only 3 out of the 11 S&P 500 sectors actually finished in the green.
Only 3. It really wasn't a case of a rising tide lifting all boats. It was a very focused flow of capital into specific themes.
So who were the leaders?
The leaders were mostly in cyclical and growth areas. Materials, XLB, was actually the top performer on the day, up 1.2%. You saw that reflected in stocks like Nucor Corporation, NUE, the big steel producer. And Uni climbed 2.7%.
Interesting. Why materials?
It might suggest some investors are making very specific bets, maybe looking ahead to potential infrastructure spending, or maybe just continued optimism about manufacturing despite the services slowdown. It's a targeted industrial bet. And naturally, technology XOK was also positive, up 0.5%, just riding that relentless AI wave we talked about.
Okay, what about the laggards? Energy falling seems noteworthy, especially with global tensions always simmering.
Yeah, energy, XLE was the worst performer, down 1.0%. Energy stocks often act as a pretty good gauge of broader economic demand expectations.
So what was pulling oil and energy stocks down?
It seemed like a double whammy. First, the obvious fear that the ongoing government shutdown would actually start to curb economic activity, reducing fuel demand here in the U.S. in the near term. And second, there was some ongoing chatter, some speculation that the OPEC Plus group might actually decide to increase production levels, maybe to put a lid on prices. That would reduce the supply-side pressure that's been supporting oil.
So energy lagging while the overall market hits records, that's another subtle sign of maybe some underlying economic anxiety.
I think so. It points to worries about industrial health, about real-world demand, even if tech flies high.
But the most fascinating signal of anxiety, the one that really encapsulates this whole nervous bull idea, has to be the volatility index. The S&P 500 hits a record high, closes at a record. Yet the VIX, the so-called fear gauge, also went up. It rose 2.1% to 16.63. How does that happen? Fear going up when stocks are hitting all-time highs, that feels wrong.
It absolutely feels wrong if you're expecting a confident, conviction-led rally. It shouldn't happen. Normally, like 99% of the time, the VIX and the S&P 500 move inversely. Stocks go up, the sphere goes down. Stocks go down, VIX goes up.
So what does this concurrent rise tell us? It's the smoking gun, you said.
It's the smoking gun for hedging activity. It strongly signals that professional money managers, the big institutions, are doing two things at once. On one hand, they have to participate. It's a risk-on environment. Momentum is strong. Records are being hit. They need to buy stocks to keep up. That pushes the index higher.
Okay, so they're buying the market.
Yes, but at the same time, they're actively hedging those new long positions. They're buying insurance.
How do they do that? Buying put options.
Exactly. They're buying put options on the index or on major stocks. Buying puts increases the overall demand for options, which drives up implied volatility. And that's what the VIX measures the market's expectation of future volatility based on options prices.
So they're protecting their gains. Against what specific risks?
Against the known risks we've been talking about. The political risk. What if the shutdown escalates badly? What if those layoff threats become real? And the policy risk. What if the Fed doesn't cut rates like everyone expects, especially when the real data finally comes out? They're basically taking risk with one hand, but buying a hefty insurance policy with the other. It's a very specific kind of cautious or nervous bullishness.
So not universal confidence at all. It's a momentum trade, maybe, but one where traders are acutely aware of the potential landmines just ahead.
Okay, so we've established the macro picture is kind of murky because of the shutdown and the data vacuum. That forces investors to pay much closer attention to company-specific news, right? Micro-level stuff, earnings, guidance, scandal, policy changes impacting just one company or sector, that stuff gets amplified.
Absolutely. When the big picture is unclear, the small details matter more. And the individual stock moves on Friday really illustrated where the conviction and the fear actually lies.
Let's look at some gainers first. What drove the big positive moves in the S&P 500? Well, on the positive side, You saw strong reactions to any sign of corporate stability or clarity. The standout was Humana, HUM, the big managed healthcare company. It surged an incredible plus 8.32%.
8%, just from reaffirming guidance. Why such a huge jump?
Because in this kind of uncertain environment, especially with a shutdown that could potentially mess with government healthcare payments like Medicare or Medicaid, a clear, confident statement from management saying, yes, our 2025 earnings targets are still solid. That's incredibly valuable. It removes a huge cloud of sector-specific uncertainty. And that sparked a relief rally, not just for Humana, but across healthcare insurers.
Makes sense. Any others? AI still playing a role?
Oh, yeah. The AI theme continued to lift individual names. AMD, for example, climbed plus 3.5%, pretty much just riding that ongoing wave of enthusiasm for chips and AI infrastructure spending. No specific news needed, just the theme itself.
Okay, now for the flip side, the notable losers. This is where we see those specific company-level risks biting hard. Let's start with Palantir, PLTR, down nearly 4%.
Yeah, PLTR fell -3.95%. The trigger there was reports of an internal U.S. Army memo. And this memo apparently cited some significant issues with Palantir's battlefield communication system.
Ouch. That sounds bad for companies selling critical software to the military.
It's potentially devastating, because Palantir's whole pitch is built on reliability, security, mission-critical performance. An issue flagged by the Army isn't just a bug. It hits the core credibility of their product. It raises questions about future contracts, especially high-value defense deals. The market reacted immediately to that potential damage to their reputation and future business.
And we saw regulatory action hitting the semiconductor sector too, specifically applied materials, AMAT.
Yes, this was a really clear example of government policy having a direct financial impact. AMAT fell -2.12%. They disclosed that new U.S. export restrictions targeting China's tech sector would directly hit their future revenue.
Did they quantify it?
They did. They estimated the negative impact at around $710 million. That's a specific nine-figure hit to their top line, purely because of a policy change.
That sends a chill through any company with significant China exposure in that sector, I imagine.
For sure. It shows the export controls are working in terms of financial impact, and it casts a shadow over other semiconductor equipment makers reliant on China sales.
And then there's the perpetual motion machine, Tesla, TSLA. Always high volume, always interesting moves. They actually reported record vehicle deliveries for the quarter, right? But the stock still fell almost 2%, make it to 1.91%. What's the logic there?
Yeah, that defies the simple good news equals stock up logic. It looks like a classic case of sell the news. But it's probably deeper than that. It's overlaid with this persistent market skepticism about Tesla's profitability.
The margin concerns.
Exactly. The delivery numbers were good, yes. But the market's focus has completely shifted to margins, especially with the ongoing EV price wars happening globally. Investors worry that Tesla is achieving that record volume by sacrificing profitability through discounts. So even with record deliveries, the stock looks potentially expensive if future earnings quality is dropping.
And this focus on company news often spills over into after-hours trading, right? We see big moves after the bell.
Absolutely. After hours is often where you see the immediate reaction to things like clinical trial results or surprise announcements released right at the close. We saw some huge movers Friday after hours, like Vivacitas Oncology, VIVK, a smaller biotech. It surged an incredible plus 88.9% on massive volume.
Wow. Must have been good news.
Almost certainly positive clinical data or maybe a partnership deal announced right after 4 p.m., a pure binary event reaction. On the other side, you had a large-cap stock, Agilent Technologies, in the life sciences space. It dropped -5.05% after hours, also on heavy volume.
Suggesting bad news came out late.
Yeah, that pattern usually points to some negative company-specific news hitting the wires right after the close, maybe a guidance cut, maybe a product issue. The market punished it immediately.
And even after hours, the big names kept trading heavily.
Oh, yeah. The usual suspects, NVIDIA, NVDA, Tesla, TSLA, Palantir, PLTR, they all continued to see huge volume after the bell. It just confirms where investor attention, where the obsession really lies, regardless of the day's political headlines or the broader economic uncertainty.
Okay, so let's look ahead. Thinking about the coming week, October 6th through the 10th, we absolutely have to start with that big shutdown caveat, right? If the shutdown continues, all the scheduled U.S. government data releases are basically tentative, could be delayed further, which just amps up the uncertainty.
Completely. Continued shutdown means continued data delays, which means the market's focus is going to get even more intense on the things it can see: Fed communication and corporate health.
So with that potential data drought, What's the absolute must-watch event for the week?
It has to be the Federal Reserve, almost obsessively so.
Yeah.
The single most critical event will be the release of the FOMC meeting minutes that's scheduled for Wednesday, October 8th.
Now, wait, these are the minutes from the last meeting, right? A historical record. Why are they so vital now, especially when the market is already pricing in almost 100% chance of a cut at the next meeting?
Great question. It's because the market has already priced the outcome, the cut.
No.
What it desperately needs now is the nuance, the texture, the details on the path forward, and crucially, the level of dissent or debate within the Fed.
Looking for clues about future moves beyond just the next one.
Exactly. These minutes get put under a microscope. Analysts will be scrutinizing every word for deeper insights into the Fed's internal discussion. They want to know, were their members voicing serious concerns about inflation still being too sticky? Or about the labor market being stronger than the headline numbers suggest?
What if the minutes show a big internal debate, or maybe suggest the bar for future cuts is higher than the market thinks?
Then that near 100% conviction starts to wobble immediately. It could inject serious volatility if the minutes reveal a more hawkish tilt or more division than expected. So the minutes will either serve to confirm the market's very dovish stance, or they'll inject some serious policy-based doubt. It's a huge potential catalyst.
Okay, FOMC minutes are key. What other data points, assuming they come out, should we be watching?
Well, we'll keep an eye on the weekly initial jobless claims, naturally, assuming that's not delayed. It's a decent real-time pulse check on layoffs. But the other big independent data point we should get is the University of Michigan Consumer Sentiment Survey. The preliminary reading for October comes out on Friday.
Why is consumer sentiment so important right now?
It gives us a crucial forward-looking read on two things: how confident consumers are feeling, which impacts spending, and maybe even more importantly right now, it includes their expectations for future inflation.
If consumers still expect prices to rise sharply, the Fed might hesitate to cut rates.
That's the worry. High confidence combined with stubbornly high inflation expectations could signal to the Fed that maybe their job isn't done yet, regardless of what the latest weak private sector report suggested. It adds another layer to the policy puzzle.
And finally, earnings season starts to trickle in. It's still early days for Q3 results, but a couple of key reports this week could act as important economic barometers.
Yes, though it's a light week, Thursday, October 9th, brings two really significant ones. First up is Delta Airlines, DAL. As a major airline, Delta is a fantastic bellwether for the travel sector, obviously, but also for broader economic health.
Now so.
The results give us a hard read on discretionary spending. Are people still booking vacations? Crucially, are businesses spending on travel again? Delta's outlook provides a tangible measure of both consumer willingness to spend and overall corporate confidence.
Okay, Delta for travel and business spending. Who else reports on Thursday?
We also get PepsiCo. With its huge global footprint selling snacks and drinks everywhere, PepsiCo is a really key barometer for consumer health around the world. Analysts will be laser-focused on their pricing power. Are they able to pass higher costs onto consumers without crushing sales volume? And what are the overall demand trends looking like globally?
So in a week where official government economic stats might be missing, these corporate reports from Delta and PepsiCo offer real, tangible evidence about what's happening on the ground.
Exactly. They provide crucial non-government data points when we need them most.
All right, so let's try and tie this all together. Our deep dive into the strange market of October 3rd really confirms a couple of key things. The market is undeniably riding high, hitting records, fueled by these two incredibly powerful forces, that relentless flood of capital into anything AI-related, and this deeply embedded market conviction that the Fed is going to keep easing monetary policy.
That's the core finding, yes. Those two narratives were strong enough, at least on that day, to completely overpower the very real, very immediate political risks coming out of the D.C. shutdown.
But, and this is the crucial but,
It's a huge but. This record-setting bullishness, it doesn't seem built on solid confidence. It feels fundamentally hedged, almost fragile. The VIX action proves it right. Investors are buying stocks, yes, but they're simultaneously paying up for insurance, for downside protection.
so the whole rally is kind of an asymmetric bet.
I think that's the right way to frame it. It's entirely dependent on the official government data whenever we get it, ultimately confirming the weak signals we saw from the private sector that stalled ISM Services report, the ADP job losses.
And if the official data comes in stronger,
Then the rapid repricing could be quite painful. It really highlights how, knowledge is valuable, but understanding its limits is crucial. The absence of reliable data is forcing traders into these highly leveraged, very fragile assumptions about the future.
Which leaves us with a pretty provocative final thought for you, our listeners, to chew on this week. Given that nervously bullish signal from the VIX and all this massive capital pouring into AI, are we basically watching investors drive a supercar at 100 miles per hour, chasing AI momentum and rate cut hopes, while simultaneously keeping one foot hovering very nervously right over the brake pedal? And maybe the biggest question is, what specific event finally makes them choose? Will it be a resolution of the political chaos in DC? Or will it be a surprise from the delayed economic data or the Fed that finally forces them to slam on either the gas or the brake? Which pedal gets pressed first?